All eyes on Dixon Tech. Dixon Tech coming out with the earnings. This time it was a strong set, but indeed the stock is down around 13%, given the fact that the company did register a three-digit growth on a YoY basis. Mobile and EPS segment contributed significantly, but what are the concerns going ahead? Are there any concerns on the growth outlook? And what are the Capex plans of the company? Let's understand more on that. And for this, we have been joined by the management. Saurabh Gupta, who is the CFO of the company, is joining us right now. Hi Saurabh, a very good afternoon and thank you so much for your time. First up, Saurabh,
Very good afternoon.
yeah, I just wanted to touch upon your Capex plans as such, because definitely we do understand that mobile segment, the growth guidance there continues to be quite robust. But this $3 billion of Capex that the company is planning for the display fab, help us understand that what kind of a backward integration this will help in. This $3 billion number looks quite significant, though definitely you are waiting for some more guidelines from the government side. But how is the company planning to manage such funds?
Yeah, so basically, if you look at, we have a large play in LED TVs, which is consumer electronics, uh, mobile phones, as well as IT hardware going forward. And this getting into the display is also in line with our backward integration strategy and focus that we are putting on, because all these three categories would require display, and that basically is in line with our strategy for backward integration. Now, when you talk about $3 billion capex, please understand a large part of this capex will be subsidized by the government, and we will only put and execute this project if we get a blessing from the government. So there was already a ISM one policy, which was basically for semiconductors and displays, and we feel that this is slightly the display is very strategic for the country, for us, for our industry, and hopefully we'll have another policy on ISM 2 side for semiconductors and display. And a large part of it, to the extent of almost 70 to 75% of the capex, should be subsidized by both the central and the state governments. So for our share of capex would be very low, and also we would have a technology partner with us, and this will be done over a period of 3 odd years, because the gestation period is quite long. And seeing the earning visibility that we have, we already have very low debt in the balance sheet, so there is enough cushion in the balance sheet. And also, as part of our ESOP policy, we expect significant cash flow proceeds from the ESOP money from our stakeholders, from our employees. So yeah, we would be able to fund it over the period of 3 years from this internal accruals and some bit of controlled debt and the ESOP proceeds. So it is pretty much manageable. The project looks very attractive. In terms of margins, it will be higher double-digit margins for us, and the paybacks will be very, very quick. So one can expect a paybacks of around 2.5 to 3 years on this particular project after the capex is subsidized by the government. Yeah.
Okay, fair enough. So you're waiting for the government's approval to come in, and then only you will go ahead and make these investment. But Saurabh, I just wanted to take a step back, and one of the worries that the street has at the company level and the industry level is that it's getting very competitive. Whether it's Tata's, whether it's others, they're looking at actively making these new relationships, which of course you have been active as well with. Do you think that could be a bit of a worry and cause a bit of a disruption? Because if one player is getting very aggressive with the pricing and all of that, it might just impact the entire industry.
See, we strongly feel that there's an opportunity for everybody. If you look at India's share in global electronic space is just a single digit today, and some of the analysts have projected that this number will go to higher double digits by 2030, and even a higher number by 2040. Clearly, our neighbor is getting expensive. They are having their own issues, and India, of course, has a strong policy framework. The labor cost in India is cheaper, and clearly we are now seeing geopolitical tailwinds also in our favor, where a lot of global companies are looking at India. So one, there is an opportunity for everybody now. One who has a large scale, a company like us who has a large scale, who's already generating a lot of operating leverage, investing in backward integration systems. We're also investing a lot in the automation and robotics, and focusing a lot on improving our manufacturing excellence further. So my sense is we would be a significant beneficiary in that overall growth that India has or an industry has. And of course, there will be other players which will come in. So if you look at all the categories, like especially in mobiles, if you look at, we have a large play on the Android ecosystem. Now, the name that you mentioned has a play on the Apple ecosystem. So clearly, one, there is an opportunity for everybody. And I think so, even if the competitive intensity improves, we would be the one who would be able to capitalize on it slightly better than some of our competitors.
Right. Sort of definitely strong performance in your mobile phone business, but the consumer electronic business, talk to us about that, because that has seen a decline of like 32% in terms of the top line on a YoY basis. What are some of the key concerns that you are highlighting at this point in time? And in that, Saurabh, refrigerators as a segment in the last 1 year, you have done well, but we do understand that there has been some hikes in terms of the refrigerant prices. So is that impacting you as well?
Yeah, so refrigerator is doing very well. Within a short period of last 9 months, I would say we started manufacturing refrigerators only in March end. So within a short period of time, we have been able to get some large marquee brands on board. We have been able to take almost 8 to 10% market share in the direct cool category. We are further expanding our capacities, and it's a 100% ODM business for us. So the margin profile in this business is also to the tune of 8% plus kind of EBITDA margins. So that business continues to do well. We are now also looking to get into other categories of refrigerators, and hopefully that should happen in next financial year. So clearly this vertical looks promising. As far as the LED TVs are concerned, yes, we are definitely seeing some challenges. The industry is not growing. There is less demand for TVs. So definitely that is going through some kind of a challenge for us. But at the same time, we are also looking to invest in some other categories like signages, industrial displays. We're looking for partnerships on industrial automotive displays. So let's see. But yeah, TVs, I would say there is some challenge in that industry. But the refrigerators and washing machines, and also we have a very strong order book on the telecom vertical as well as our hopefully in our IT category as well going forward.
Okay, point taken. So you're looking at diversifying, and that softness in TV hopefully would come back in a couple of quarters. But your of course growth rate has been very strong if you look at it on a year-on-year basis. But now the challenge of scale will start coming up. What do you anticipate are going to be the growth levels in FY26, both in terms of top line as well as bottom line? Any estimates?
Yeah, so we are in the middle of the budgeting exercise. We will have those numbers by mid of March, hopefully. So that budgeting exercise is going on. But seeing the order book that we have in mobiles, because a lot of these customers, which has only started the operations in this year, would have full year numbers for next financial year, and also there'll be a further ramp up to those numbers. Some of the new customer additions which have happened in H2 only will have full year numbers for next year. Then we have a large order book, decent order book in IT hardware category. We have a large order book in telecom. So my sense is next year also we are looking at very strong growth. Hopefully the growth can be upwards of anywhere between 40 to 45%. But yeah, one has to wait and watch on the budgets, which will be finalized in the next couple of months. But we are looking for a very strong growth along with some kind of expansion in margins as well next year.
Talk to us about the opportunities that you are eyeing in the mobile segment, the kind of order book build-up that you are expecting, the customer additions for the upcoming year, and also what are the export opportunities that you are spotting at this point?
Yeah, so this year we have done a volumes, or will be closing with the volumes of almost 30 million smartphones. The total Indian market is around 150 million. And the order book that we have, definitely we should be upwards of 40 to 43 million smartphones for next financial year. So clearly we have a strong order book for next financial year.
All right, Saurabh, with this we'll let you go on that. Thank you so much for taking the time out and speaking with us, also helping us understand what is the growth outlook looking like by the management. So that was the management of Dixon Tech telling us on the Capex front that if only they get subsidy, which is now close to like 70 to 75% of the contribution coming in from the state itself, they will put a Capex of like $3 billion that will be having a 3-year timeline, and the company is looking strong in terms of the cash flow generation as well. So that was the management of Dixon Tech.
If you like this video, then like, share and subscribe to ET Now.